Hi, my name is Bianca Sams. Thank you guys so much for coming. I see about 154 people here. We were waiting to let a few more people in, but we're just going to get started. Hi, my name is Bianca. Thank you so much for coming. This event is called Should I Incorporate, and other questions that people might have. You all should have gotten a PDF copy of the slides. We will not be showing them. You have them, so we will hopefully be going through them as we go along. Everybody else in a second. But thank you so much for coming. I first have to say the disclaimer that the WGAW does not endorse, promote any approach or method, theory, or system of financial planning, nor does the WGAW endorse or promote any individual speaker or company. So now that we have the technical stuff out of the way, we're going to get down to business because there's so much amazing stuff here. And first up is Paige. Please introduce yourself.
Hi, my name is Page Villaluna. Thank you for taking time out of your busy day to hang out with us tonight and talk about taxes and corporation. I'm a certified public accountant here in Woodland Hills, California. I've been a guest speaker in the past, and I just hope you get a lot of information, useful information tonight. And I think we have a great panel for everyone.
Awesome. Next is Belva.
Hi, everyone. My name is Belva Anakwenze. I am a business manager here in Los Angeles. My clients are writers, producers, and the such here in Hollywood. And hopefully you guys enjoy the presentation.
And last and definitely not least is Mr. Sid.
Hi, my name is Sid Quashie. I live in Los Angeles. I'm a writer-producer for the television show Charmed, with Bianca, by the way. And I'm just here to give the writer's perspective. Sometimes as writers, we don't know what a corporation is and why we should get it. And I'm just giving you the ground level's view as a writer, and I hope you get a lot out of it. So happy to be here.
I love it. Yes, I asked Sid in part because I did this panel 3 years ago. I got roped in to do it, and part of it was really exciting and I think helpful, and would have been helpful before, was having a writer, people who actually incorporated, sit through our different experiences. I have a C Corp. Did you have an S Corp?
S Corp. Yeah. Yes, that's right.
So how did you incorporate? Like, how did you hear about incorporation? When did you start? When did you think about it? Like, what are the steps you had to take?
Yeah, I didn't start right away. Principally because I didn't know anything about a corporation. I just thought corporations were big giant things like IBM, GE, and all that. Didn't realize that we could, as writers or creative people, even have them. So it took me a long time, and I was talking to a manager I had way back, and he said, "You're starting to earn enough money where it would be wise for you to think about incorporating." And I hadn't thought about it, and he put me on to a business manager where I was able to ask questions, what the benefits would be, how much it would cost, and ultimately why it would be wise for me at the place I was in my career to think about incorporating. And the first thing I heard was loan out. I kept hearing this word loan out, and I was like, what is a loan out? And so that was one of the first big things I kept hearing in all these contracts. Do you have a loan out? Do you have a loan out? And when I found out what it was, I was like, oh, it makes sense. You're loaning your services out to whatever company's hiring you. And I said, oh, that's pretty simple. So, it took me about, I'd say, 10 years before, as a writer, before I really started to understand, what incorporating was. But once I did it, I never looked back.
And what are some of the things that you've had to do or you wish you had known beforehand that somebody had told you?
Well,
because there's a lot
about incorporating. Yeah, I mean, I think the frightening thing for me as a layperson was the language, just dealing with taxes and payroll and what I pay and what I don't pay. It just felt like I had no education about that. And so I think that was the scariest and most confusing thing for me as I was starting to incorporate. It was understanding how much goes into it. First of all, how much you have to pay to incorporate, the cost you're going to have to incur once you do incorporate, and what you can and cannot deduct as what they call a qualified business expense. And so as a writer, as a creative person, there are so many things you can deduct that you have no idea you could deduct. And there are other things that you think are obvious, but that don't actually meet the qualifications. So
right.
Just
and
getting
they change, which is even better.
Yeah, exactly right. And they change, and so just getting up to speed on what the benefits were and what I could do was a great education for me as a creative person, as a writer. I think that was the biggest thing for me.
What would you say some of the benefits are that you've experienced?
Definitely deductions. Just being able to, with the qualified deductions and reducing what the government can actually tax you on is, what your actual taxable income is. You can earn 500,000 a year, but that doesn't mean you're paying taxes on that. It's all about where you are after everything is deducted from that. And I think that was probably the biggest thing, is just what I qualified for, what the deductions were, and then understanding that I was actually an employee of my own company. So in other words, that when I got a job from whatever CBS or whatever, they would pay my company, and then I would actually ask my manager for a check. So I became an employee of my own company, understanding that being able to deduct all these taxes, being able to have somebody handle all the things that were coming in and keep track of them, I think it was a huge benefit. And just in the year after I did it, the difference, it was night and day between I was doing a W-2 and what I ended up paying when I had my corporation. So I think for me, the benefit was definitely taxes. Huge.
Yeah. I think it was also, for me, it was an interesting thing of changing mindset. I heard about loan outs fairly early, but was just asking questions for a couple of years. But then when I actually did it, it really, really was like, I started thinking of myself as a business owner, not just somebody else's employee or writer for hire. It's like, no, I am my own business, and what that means and how you think about jobs, what you can do, what you can't do, what you can leverage, what you can't leverage, either be it taxes or not taxes. So for you, and now that you're a business owner and you're thinking of yourself as a business owner, you have to also think about people that you have to employ to help you with your business. So How did you find your accountant? How did you find your, the people who help you maintain yours? Was it through friends? How did you figure out how you were going to find the right people?
It was actually through my creative manager. I had an agent and a manager at the time, and my manager said, look, we work with this company that has been great for us. And so I said, great. I didn't know anything about it. I said, put me in touch with them. And that first meeting, I just went in there and I said, look, this is what I'm making. This is what I think I'm going to be making this year. And does it make sense for me to incorporate? And they just were really patient with me. They answered my questions, what I could expect, what I couldn't expect, and setting up what I consider to be realistic expectations for myself. And I just at that point had to decide, is it worth it? And I decided that it was, given where I was at that time. So it really was through my manager directly. And I think a lot of times you can ask your friends and stuff, that everybody has somebody, and they're only like 2 or 3 steps removed from that. And it's good because It's such a small town. People know who's good, who isn't, experiences they've had that are good or positive or negative. I think it's always good to try to look to your own group, because somebody knows somebody who knows somebody. And I think that's probably what happened with me too. So.
Yes. Another big question that I had to ask myself quite a bit was, every year, I mean, we're writers, so sometimes you're on a show, you do film and TV and other things. So your finances will go up and go down. And, once you have a corporation, you still have to keep. So how has it been for you with the fluctuations of our business and the way we have to work, where some years you're working more and some years you're working less, and how funds are coming in and coming out? Has it still felt beneficial? What has that been like for you?
I think for the most part, it's been still beneficial. Like you said, it's a feast or famine for us as writers and as creative people. So there are some down years, and I think if you have a good business manager, as Belva and Page will allude to, you plan ahead. A lot of times you just try to plan ahead and say, look, if you have the next year, if you don't know and don't expect to be having something because you're not on a regular TV show or you're not on a feature or something, we got to plan ahead and see, can you go 6 months to a year and have something in that account that is still, benefiting you? And I think for me, that was the biggest thing, planning ahead. Because like you were saying, Bianca, I have to start thinking like a business owner. It's my company, and I have to understand what I'm planning for in the future. And so I think that's the biggest thing for me, was looking a year, 2, 3 years ahead, going in these 3-year increments and saying, what can I reasonably expect? What should I, make sure I have in my account? What can I carry over? All those things you start to think of. And so it becomes like the business of show. You have to really start to understand what it is that you're planning for. Because some years are not going to be, the years that you had before. And so if you plan ahead, you can at least make allowances for that. And that's kind of what we do with my business managers, to try to project what we're going to be getting in the next year.
You're on mute, Boo.
I love this. I'm forever muting myself. Technology is so much fun. So I have a C Corp, which is a little bit slightly different. And so Paige and Belva are going to talk a little bit about what the difference are between these two things. But before we get to them, I have one more question for you. If you think back when you started it, if there were 2 or 3 things you wish you had known, or you hope that we answer tonight, or about, like, what do you think for you those things would be? Like, if you could talk to yourself from 5-10 years ago to think about incorporating, like, what stuff do you wish you knew?
I think I probably wished I knew just you're gonna have to pay a little bit to maintain your corporation. Between having your business manager, your accountant, there's a lot of things that you have to do quarterly, and it's just, you have to understand that they're just business expenses. You have to just include them in. And I think the biggest for me is just getting used to paying payroll taxes, especially if you employ somebody in your company. You are a business owner, you're going to pay taxes. And when you look at that bottom line, it can be shocking sometimes, because you are the business and you are paying all the taxes.
And insurance.
Right.
Yeah, and insurance and employment taxes. And sometimes that sticker shock can be really, really harsh. So that's what I wish I knew. Somebody opened my eyes to go, hey, Sid, you need to know that as a business owner, you're going to start to understand what it means to own a business, and sometimes it's the bigger thing that you want to face. So that's probably the biggest thing.
Yes, that was interesting. Quarterly taxes is not a joke, and you have to pay them. I think there's a lot of people who think I incorporate and it means, oh, I don't have to pay taxes, I don't have to pay Uncle Sam, and it's like, Uncle Sam's gonna want his money, and he gonna want all his money, so you're not gonna not pay taxes. To me, the big thing that I learned was leveraging money, though, because I get my money first, and then we pay taxes later. I still have to pay my taxes, but they'll explain a little bit more. But I thought it was interesting where it was like, where I would have to save all my little pennies to try to get a new computer, even though I'm working on a show, and hope that deduction at the end of the year Uncle Sam would accept as a W-2 was like, this is an honest to God business expense that we all have to have because we are writers, and purchase that computer because I need it. And then it is used, against towards what I have to pay my taxes. So to me, it was learning the difference between pre-tax dollars and post-tax dollars, and the fact that, like, I'm going to pay Uncle Sam, but he gets it later. I get to deal with the business expenses I need to deal with first. And then, we just plan for how much I'm going to owe when I have to owe, which is great. So with that, I think we're going to pivot to Paige, who's going to give us a very brief overview of just what is a corporation? Like, what does it mean? We've been saying S Corp and C Corp, and they sound, big and highfalutin words, but there's some pretty basic stuff that you can learn, and he'll talk about the taxes and things like that. But tell us in plain English, like, what are we talking about? What is this S Corp, C Corp thing?
Okay, so I'll give you the most general term of a corporation. You could think of a corporation as a person. So in the eyes of the law, there's something called a natural person and an unnatural person. A natural person is someone with a breath and a heartbeat, and an unnatural person is somebody who is formed by the state. So you can think of the states as almost like mothers. The states give birth to this unnatural person, and you could think of a C corporation as a child, and you could think as an S corporation is like another type of child. Each child has their own type of abilities. One child might be creative, one child might be logical. And then so they have different characteristics, but they're both special, and they can both accomplish, different things. And there will be different reasons why you might want a particular set of characteristics for, the given circumstance. So what I'll do from here is we had a little bit of technical difficulty in trying to present the slides along with our faces at the same time. And to try to maintain somewhat of a personal connection, we felt that if you can, turn to your slides, and then that was going to be our general format. I'm going to the slide where it says, what is a corporation? Okay. And back in the olden days, it used to be you would have a C corporation, and there would be something called zeroing out your corporation. And essentially, all that meant was if you had profit in your corporation, you would find a way to take that profit out of the corporation so you wouldn't make a corporate tax. Later on, something came along called an S corporation, where it didn't have as much consequence in terms of retaining money in your corporation, because in an S corporation, instead of paying taxes at a corporate level, those profits were moved and you were taxed on your individual level. So I'll go on to the next slide here, which is, see here. In terms of a corporation, so let's see if I could find a slide where we could use an easy picture.
I guess, yeah, and like also just talking about sort of the pros and cons, like why would people incorporate? You've given us the big sort of general term of it. If we think about it insofar as writers go, what is an S corp? What is a C corp? Why would they get one? Why wouldn't they get the other? What's that work like? What does that look like?
So what happened under the new tax law is, if you were being treated as an employee, the big deductions that you had were your agent and manager fees, and they were pretty substantial. So let's
fees.
Sorry. Let's just say they were, I don't know, 25%, and you made $100,000. You would have $25,000 of deductions that you couldn't take. Suddenly, that became a very big deal. So now what happens is, the way the new tax law was designed is they did not take away those deductions if you were incorporated. So now, if you formed a corporation, you suddenly were able to recapture those deductions. Now, what's interesting is a C corporation, or an S corporation, I should say, is essentially a C corporation that just made an election with the IRS that says, hey, IRS, I don't want to pay taxes at the corporate level. I want to pay taxes on my individual tax return for my corporation. So an S corporation is just a C corporation that has elected to treat its taxes on its personal tax return. Now, the major thing why in the olden days people would use a C corporation, one of the big benefits is that you were able to capture a lot more medical deductions on a C corporation.
You still
yeah. And
another question that people have asked are, what about LLCs? There's a lot of people asking, why can't I use an LLC as a loan out? It's not the same thing.
So I talked to one of the top people over at EP on this, and their methodology was, for tax purposes, an LLC can be disregarded as an entity. So if you're a single member LLC, that just means you're a sole person who set up an LLC. The IRS treats you as if that entity doesn't exist. And what my thinking is that the risk involved is, if this is a disregarded entity and we're not withholding payroll taxes, we could end up with a type of payroll or employment liability. So to the err on the side of caution, we will basically recognize C and S corps
only. And Page is correct. And so a couple years, up to about 5 years ago, you could have an LLC. But now with the crackdown and all the state laws around employment issues and labor laws, they have now, most studios and most payroll companies will not allow you to be an LLC for that reason.
Great. Yeah. So LLC, not a thing.
Not anymore.
Now, in terms of C corporations, one of the other things that makes a C corporation very strong is in federal bankruptcy courts, when you're trying to pierce the corporate veil, and what that essentially means is, remember I talked about corporations being their separate personhoods. If something were to go wrong, you just blame this other person. That's not me. You could think of your corporation like the fall guy. Well, in different courts can basically ignore corporate structures, or they could say this corporate structure is invalid because you didn't follow this formalities. What they're finding in bankruptcy courts is that corporations that tend to maintain, their corporate shield are C corporations, and things like single member LLCs and S corps have been penetrated more by the courts than C corporations have. So in terms of creditor protection, a C corporation can be stronger for that purpose. Now, one of the things that the new tax law did was it made C corporations more viable than they did in the past, because in the past, your corporate rate could go up to 35%. So now that we have a flat 21%, it might be something that advisors might consider, especially with the type of litigation risk we have in California. So whenever we look at corporate structures, the tax is a component of the entity choice, but it's not the sole component.
Great. So a question here that I think helps, we talk about recapturing deductibles for agent, managers, attorneys. That means if you're incorporated, those become taxable deductions, correct? Versus if you're personal, where it is gone, correct?
That's correct. And something that the new tax law introduced was something called the Section 199 deduction. And the Guild had written, to the Treasury Department and made all their arguments on why they felt that they should qualify for the deduction. And unfortunately, the IRS and the Treasury in their final regulations had said, hey, that's not our opinion. But within a corporation, if you could control the earnings, you can actually control whether you capture that deduction or not. And there's methods for how you're able to do that.
Great. Love it. Okay. Are there any other big things that we need to talk about insofar as what is the difference between an S and a C? I know that Belva's going to go into some of the particulars about money and funding, but as we're doing an overview, what are other things, like maybe some pros and cons of one versus the other? If you have to, think of any right now as we're doing sort of the overview section.
So in general, if you ever end up in a situation where, let's just say, I don't know if everyone's heard of what happened with the PPP loan or the EIDL. Those were essentially, the PPP was set up as a type of grant loan that was set for forgiveness. The EIDL had a grant portion, but the other part of it was made to be paid back. Everybody kind of thought one of the loans, say the EIDL, was free money. But if you didn't pay back, the government had a personal guarantee to that loan. That personal guarantee would have been an amount in excess of $100,000. If you did that loan without a corporation, your personal guarantee is essentially all the assets you own under your name. If you had a corporation, that guarantee would have been limited to your corporate assets. Now, another thing too is taxes. You could end up in a situation where people will set up corporations, but they're not aware of how significant the compliance is and all the licenses that you have to have and all the reportings and what happens if you miss a reporting. And Sid talked a lot about the payroll tax reporting, and the payroll tax reporting is very significant. There was a case called the Raylight case, and essentially what this case did was the Franchise Tax Board tried to pursue corporate shareholders and assign personal liability for the taxes. And what had happened in this case was the court said, no, those are corporate liabilities. They remain at the corporate level, and they enjoy the benefits of the corporate shield. So in in instances of income taxes, your corporation, if you ever became non-compliant, could potentially shield you from tax liabilities if you just couldn't afford it.
Great. Yeah, it's interesting because it's the general thing is there's so much alike in very many ways of what one corp does and what one doesn't. There's a few things in between that, why I chose a C corp versus an S corp or whatnot, but a lot of it, tends to be the same, which Belva's going to get into, which I'm really excited. So we're going to pivot a little bit.
What I would say if you don't meet with your tax advisor by like November or December or shortly after October 15th, and you're not meeting with them before the end of the year, a C corporation might not be the best vehicle, because if you have an unplanned year, you could have a very heavy tax surprise. So I would say C corporations should be reserved for people who have a more intimate relationship with their tax advisor or a continuous relationship.
Although with a C Corp, you can also split your tax year. Your annual year and your tax year are not necessarily the same thing. So if that does happen, so for me, for example, I have a C Corp. My end of fiscal year is the end of January. I started my C Corp in the middle of like March or whatnot, in the middle of a year, which actually meant I didn't have to deal with the taxes until the following year because I had a year to do it and we hadn't actually got to that year. So it gave me a little bit more time actually for me, because I ended up changing accountants in the middle of the year to get things together, but I knew I had to do that. So C Corps are weird because of that, your fiscal year and annual are not together. But I think he's in the point that all of this is personalized. We're only giving general information. You have to know your own personal issues to be able to figure out whether a C or S Corp is right for you. And you have to go to somebody like Belva or somebody like Page who can go through all your finances to tell you which one is right, C or S. But Belva, you're going to get a little bit in.
Yeah, and I do want to bring this up. Sid had mentioned the cost, and he talked about feast or famine. I did want to let you know that if you got into a situation where it's like, I can't afford this corporation, there is a method to shut it down, and you could close it so that if you ever hit a dry spell and it's just something too expensive for you to maintain, you could do that. And let's just say something comes along later and you get, like a big series, you can revive that same corporation and bring it back to life and reuse it.
Yeah, I think Paige makes a good point. That's very important. Oftentimes, once you have a corporation, the idea is that you're kind of committed to it because you're getting residuals in that name. You have a bank account attached to that name. So it's not something to go into lightly because you're giving birth, as Paige would give the analogy, you're giving birth to this organization. And so you want to make sure you're committed to it because there's so much tied to it. Like if you have residuals for a show that you wrote on 20 years ago, it's a nightmare to then go back and say, well, I'm not making enough money in residuals anymore. It doesn't make sense. It's possible we need to go back to the WGAW and make sure the residuals are now being paid to you individually. And it's a whole wind down process, which Paige put in the slides for you guys.
And one more question, Paige, before we move on, is about unemployment. Like if somebody has a loan out, we're creating our own business. We keep saying we're creating our own business. Does that mean at the end, if I needed to file for unemployment, that I could no longer do so as an individual? We're paying taxes as an individual, correct?
Yes, that's correct. So when you pay yourself, basically, essentially, you're paying yourself paychecks. You are contributing to Social Security. You are contributing to California unemployment. So you are entitled to those benefits.
If you're running payroll. So if you are not running payroll, but just taking draws out of the company, in the normal world, you are not entitled to get unemployment. There was a caveat, this because of the pandemic, the government then allowed anyone, no matter how you were earning money, you were a gig worker, not paying payroll taxes, you still could get unemployment. But in the typical world, if you are not running payroll and withholding taxes, you are not qualified for unemployment.
Now, this is something to keep in mind since this is an unusual year. You had PPP generally for employers, and then you had unemployment for people that were employees. There are people that had loan outs that were claiming both. The intent of the law was that you claimed either or, because I've seen situations where people have claimed both. And essentially, they set it up to where if you were claiming PPP, their intention was not for you to claim both.
Got it. Okay. So that takes us through the basics of a C Corp, S Corp. We have things about double taxation, no federal thing. Belva, is there a particular slide you want us to start on? Is it 21 that we can say that they're starting around? They're looking at the K1 forms, just to give them a heads up of where we're starting. Am I muted?
You keep going on mute, so you're going in and out.
Oh, I don't understand why this keeps muting me.
K1 form, if you have an S corporation and you have, let's just say you have a 50% ownership because it's a husband and wife that share the corporation, the K1 form, which is on slide 22, will show your percentage of the profit or loss of that corporation. And this form essentially will end up on your personal tax return. And whoever does your taxes will use this form, to help determine your tax liability.
I think that's important. I've had clients that will incorporate at the end of the year, and then they'll go through TurboTax or however they do their taxes normally, file their personal tax return, and then say, oh, can you do my corporate return for me? And then we have to then help them fix their personal return because they didn't account for the fact that when you have an S Corp, the corporate return happens first. That information goes in the K1. The K1 then goes in your personal return. So I've had clients end up getting refunds on a personal return. We have to amend it and fix it, and then they end up owing $20,000, $30,000 because they didn't account for the business income when they filed their personal taxes.
So you're going to do the cost-benefit analysis. Like, how do people figure out should they or shouldn't they Corp is?
I can tell you that you should not.
Or the basic.
In my opinion, WGA does not blah, 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 blah. In my opinion, you should not be entertaining an S corporation or a corporation unless you're making around $250,000. That's my opinion. Page may be different, but for me, because it alluded to the fact that there are, on top of the, yes, you may save money in taxes, but then there's more obligations you have. You have business taxes, whether it's $800 filing fee every year. You have statement of information. You need to hire somebody to help you do the accounting, to help you do the taxes. You may have a business manager. You may not. You may hire people. So sometimes you may save money in taxes, but you'll end up spending more money in services, or you'll end up spending more time tracking your business expenses to save $1,000. It's not worth it to spend all this energy keeping receipts and tracking stuff if it's not your gift, trying to save $1,000. It's not worth it. So for me, it's $250. What about you, Paige?
I agree with that. You don't want to be making more money and then giving it to a bunch of professionals and then you're kind of breaking even. And the only thing that I would add is if you were going to be consistent with the earnings, because if it's a one-off year, you probably don't want to do that either.
Agreed.
So on average for writers, that's somewhere around story editor, ESC level, where if you're in a show, I mean, if you're doing features, that's going to be separate. But if you're on a TV show, that's somewhere around ESC, SC status, that you're going to you'll have some residuals and you'll be consistently making money. So it's anywhere between like 150 to 200, and then sometimes it gets to 250. So for TV people, that's an easy sort of barometer, because I think a lot of people, like, money is harder to gauge when ours tend to flux, and because shows are shorter and longer. So it tends to be somewhere around there. I was told it was like 150. And then you also have to think about the fact that you have to project forward, like Belva said.
So there's also people who are multi-hyphenated, right? You can be a writer, a producer, So also we look at the aggregate of all of your income in years, right? So if you're going to make maybe 150 this year, but you have a contract, you're going to make 250 the next year, then maybe we do incorporate this year to kind of get some of the tax savings and then ramp up. but it's a conversation if you know that you're on the right trajectory. So again, for me, 250 is a number, but we'll have more conversations if you have a slower year. And one of the sites talks about this, but if you're in the middle of a contract, studios typically will not allow you to be an employee at one point and then have a corporation or vice versa. So oftentimes, if we know when someone's starting a project in December, which is now happening during this freaking pandemic, everyone's starting at different times, we'll say, well, yeah, you're only going to make $20,000, $30,000 this year, but we have a 3-year deal, blah, and then we'll actually do it now. That way, all of your money falls into the corporation.
Yeah, because it's really hard to get them to renegotiate between seasons. Like I've heard a couple of people do it, but traditionally, if you're on the show, it is rare, and you do not want to have the legal fees on top of that and the wrangling and the nonsense. So yeah, like I had
people are hired per show, and each show is its own contract, and even still, they're like, nope, because we've already paid you. It goes back to the labor law we were talking about, and either you're an employee or you're not, and that's it.
Yeah, and I mean, there are people who I've met who've done it as staff writer, but only because they were doing network shows where they knew they had 22 episodes a year, and by the time, you know what I mean, they got to story editor and they would get maybe 2-3 episodes, they were like, nah, we can't renegotiate in the middle. We're going to take the cost at the beginning and then, you know what I mean, shift it over. So Thank you for saying that. I'm going to let you continue.
Is it on me now? Or are you done, Paige?
Yes, sorry. Yeah. So Paige is done. We're going to talk about sort of the cost-benefit analysis, Belva.
Okay.
Like, what do you think?
So you guys, so you know, I am now looking at my slides, so bear with me. So I'm on deck slide number 28. I'm going to show you a couple, hopefully you guys have your PDFs or whatever, and you guys can follow along. And the idea is to show you someone making $150,000. We're going to compare that person making $150,000 to the person making $80,000 a year. We're going to compare it to the old tax law, and then also compare a couple scenarios as it relates to if someone was to incorporate versus a C corp versus an S corp. I told you my answer is $250,000 if you want to incorporate. So now I'm looking at the slide that says a staff writer making $80,000 a year. So the first column talks about under the old tax law. This is before the Jobs and Tax Act that came into play in 2018. And basically it shows that you had a gross income of $80,000. At that point, you were able to write off your commissions and other deductions that you were paying out. And then you would be able to basically, in essence, write off roughly $43,000 if you're making $80,000, paying, you know, $25,000 in taxes, blah, blah, in percentage. And so you would pay a total of $3,000. That's actually, I apologize, that's based on $150, not based on $80. I'm sorry. You would have paid roughly $7,000 though. And then under the new Jobs and Tax Act, if you stay a W-2 employee, your gross income is the same. You no longer are able to write off your commissions, but your standard deduction is higher. That's $12,000. Now your taxable income is $68,000. So you're paying roughly $10,000 and some change in taxes. Now you'll see the very first example is someone who is a C corp and they're paying $11,150 into their SEP IRA. That's their retirement account, their self-directed retirement account. And because they're doing that, they're also going to spend about $7,000 in payroll taxes, and that's up towards the top, and $7,000 is hold. And you'll see that their taxable income drastically goes down, but once you add the federal tax plus the $7,000 in business taxes, you're going to end up paying $10,391, which is very close to the $10,000 you would have paid if you were just a W-2 employee. So hopefully all that makes sense. So there's no real cost savings if you're going to completely max out everything. Now, the only thing you're doing differently is you're contributing $11,000 to your retirement. And if you're making $80,000, you actually may not be able to fiscally be able to do that, especially if you're in LA. You may not be able to handle the cash flow perspective in that sense. So you have to be able to commit to doing it. The next example shows somebody not doing the SEP IRA. So they're going to pay more in taxes because they have to pay a higher salary because they're not writing off the retirement account. and you're actually going to end up paying $13,000 in taxes. So you're actually going to pay more money in taxes as a C Corp without a SEP than you would have paid as an employee. And that does not account for tax prep for the business, accounting, whether it's a software you use or something else. It doesn't account for any of that. If you do a SEP IRA with a S Corp, it's very similar, about $10,000. No huge money savings in tax, except you put away $11,000 into your retirement, which is great if you can afford to do that on $80,000, which in my head seems kind of hard. The only difference is you have a SEP IRA, don't run any payroll or any SEP contribution. You basically have your income, your expenses, and then your profit. That profit then gets passed on to you. If we do it like that, you end up saving you end up breaking even, honestly. I know the tax law, the 2017 is incorrect, but you end up breaking even. And people are asking in the chat, and I saw it, they're talking about what's a reasonable amount of income. So the IRS gives you a little bit of grace period where you don't actually have to run payroll. But at a certain point, they're going to say, well, how has this business been around for 2 years? You're making $150,000, $300,000, there's no salaries. They're going to start asking questions. So, in my head, again, at $80,000, this doesn't make sense. Paige, are you saying something?
No, I agree. It's not really. The only thing that I would say is if there's a technique where you could subject part of the S Corp distribution to employment tax, and I'd kind of like to do at least $5,000, $6,000 to make sure that they get their Social Security credits for the year, because Social Security is based on a 35-year average, and you probably don't want to have a missed year of contributing to the credits because you could pay for it later.
Yeah, so in my head, you're making $80,000. It just doesn't make sense, and honestly, you don't really save any money at all under the new tax law. So why do it? And then I talked a little bit about this, but basically when you pay yourself salary, you actually have to pay FICA, federal unemployment, you have to pay Social Security, disability insurance, state unemployment, state disability, and all those things add up, and it ends up costing you about 7.5% on the employer side, and then 7.5% as the employee. That's 15% on taxes, which is not part of your income tax. So payroll gets costly, as Sid was telling you. So it's important to understand that when I gave the example of actually not paying yourself a salary, you're saving that 15%. But at a certain point, the IRS is going to come hunting you down saying, why aren't you doing this? So the next example is somebody making $150,000. So it's the same type of flow. You're making $150, you're writing off your commissions, you have taxable income of about $120. You're going to pay about $29,000 in tax. Under the new tax law, because 2017 is old, it doesn't matter anyway, you're no longer able to write off your commissions that we talked about. So now your taxable income is $138 because you get the standard deduction of $12,000. So your federal tax liability is going to be $33,000. So $33,000 is our threshold we're trying to beat in terms of does it make sense. So if you go to the C Corp with a SEP, you're making $150, you're paying 25% in commissions, you're going to pay about $13,500 in payroll taxes because the idea is that we're going to zero out the corporation. So the corporation is going to have income, expenses, and then we want the bottom line of profit to be zero, and we're going to do that in the form of payroll. So we're going to pay $13,500 in taxes. We're going to put $21,000 into your SEP IRA. That brings down your personal income by the money you put into the SEP IRA. And you scroll down and then you end up paying, your taxable income is $66,000. These are all estimates, by the way. And then your federal tax liability plus the business taxes you paid, you're at $23,000. So you're saving roughly $10,000 in taxes for yourself if you were versus an employee versus being a corporation with a SEP. But again, this is assuming you have the cash and ability to actually contribute $21,000 to your SEP IRA. If you don't, that puts us right back at the next example, which doesn't show us paying any money into the SEP. You're going to pay about $16,500 in business taxes, And then you'll get to the very bottom, you'll see you're going to pay a total in taxes paid between you and the business, $30,824. So if you're not going to contribute to your SEP IRA, you're going to pay $30,000, but if you just were an employee, you pay $33,000. Why are we doing this? It actually doesn't make sense, because now you're saving $3,000 in taxes, but now you have a tax return you have to file. You may need software to help you track it. You may have to hire a bookkeeper to help you, and the list goes on and on and on. So it just doesn't make sense. It starts making a little bit more sense when you get to the corporate without payroll, without a SEP. You look at the numbers. We're not running payroll. We're not doing a SEP contribution. You're going to end up paying roughly $18,000 in taxes, which is great. But again, the IRS may come knocking because you're not paying that extra 15% in employment taxes. So hopefully that all kind of makes sense to you. Anything you want to add to that, Paige?
Yeah. No, I think the thing that you did that was really well laid out was you pointed out when people don't have the money to contribute, because oftentimes you're looking on the internet and they're saying you could put away this amount, you could put away this amount. And whenever we do our tax planning, which is like right now, I always ask the clients, how much cash do you have total in bank? How much do you need for your reserve? How much can you separate with? Because you have to take into account the budget and liquidity part of it. And I think that was a perfect example. So.
And to your point, Sid said reserves, you need 6 months in savings account. I don't want to give away $21,000 into my retirement account and not have any cash available for an emergency. I've been preaching, as Sid said, feast or famine for at least 5 years, that 6 months of savings is most important. Everyone thought I was crazy, and now we're in month 7 of a pandemic. Luckily, writers are writing again, but for a long time, everything was just kind of stuck. And so it's important that you don't want to deplete your cash reserves just to make retirement. Obviously, I believe in investing in saving for your retirement, but it has to make sense holistically for your financial well-being.
Can I add something real quick, Bianca? Real quick. What Belva said is really important from a writer's point of view. I had a situation where I planned for a SEP of $25,000, which reduced my taxable income. It was due September. I didn't have a great year, and I didn't pay the $25,000, and Uncle Sam came quick to get his pound of flesh. So I would say, if you're going to do a SEP, make sure, as Belva and Paige are saying, you have that money, because when September 15 rolls around, you better have that deposited, or Uncle Sam's going to get that money. So that's really important.
Or deposited immediately, which is what I did. I was like, as soon as I get that paycheck, it is going directly into the other one, because we're not going to have to wait and be like, oh, I can take a cruise. No. Well, now nobody's taking anything, but no, you can't. I mean, it's an interesting thing, because another question is, besides the oftentimes a lot of writers aren't even just talking about the taxes. They're also told about, like I said it a little bit earlier, and I think it's just because it was how it was presented to me, is like people are like, well, I don't have to pay taxes, immediately. I get my whole paycheck when it comes to me. And they think to pay, like, no, he's going to get paid. It's just different. Like the way it works is different based on deductibles and things like that. But like,
you have to plan for it. And so,
exactly.
Yes, there's a great benefit for you getting all of your money up front. I 100% agree with you that has great benefit. But it also comes with great responsibility and great risk. So it's important that you
let's talk about those responsibilities, because I think that this is, the basis of corporation seems fairly simple, right? You're gonna figure it out with your tax provider. They're gonna go through your taxes. They're gonna look at your finances. You're gonna do the plans. You're gonna go through stuff. They might suggest a C. They might suggest an S. But that is very individualized, right? Like my needs and Sid needs and other people's needs are going to be different. But there are some responsibility things.
So let me say this. Before you talk to your friend who does this, and you have a mentor that does this, please talk to somebody who understands entertainment, and someone who is either an attorney or an accountant or a business manager or whatever, that actually understands entertainment and understands the nuanced life that you all live, right? So that's the first piece. I don't want you to go to LegalZoom. I don't want you to go to any other website and just create a corporation. No, 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 no. I don't care who you call, but call somebody and make sure you get some advice. Because, to the point is, there's an $800 fee in California. Every year you have to pay. It's called the, you have to file it. It's like the minimum tax in California. Some states don't have minimum taxes. This gets very nuanced. But if you're a writer that writes on the East Coast and the West Coast, we may have to track your income separately. So I have a client who writes on a show in New York. I have a client that's also writing here. So her company is formed in Delaware, and then we have to track her income by state. Because I don't want to pay taxes in New York on her California income, and I don't want to pay taxes in California on her New York income. So now I'm tracking income and expenses by state to make sure that we're only reporting to New York what's important, we're only reporting to California what's important. And we use Delaware as like a neutral ground just to say we don't pay any taxes. It's like an annual fee of $50, something like that. But every state has their own fee, and it's important. So once we start doing this, one is the fees you have to pay to the state, whatever state you're in. California is $800. And then it's also, if you're somebody writing in two different states, you have to then track your income differently so that you're not paying more taxes. You don't want to claim all your income in New York if you're making half of it here. So that's important. In California, there's also a statement of information that people ignore all the time. It gets sent in a postcard, and it's $25. But if you don't fill it out, it costs you $250 in penalties because you didn't fill it out. It's due in the month that you file the month you incorporate every year. The city of Los Angeles requires a business license. I think it's free for the first couple years. After that, it's a percentage of your income. So it's important that, again, if you're going to do this, understand that it's not just saving money on taxes. It's a huge responsibility.
I love it. You said something that I want to ask one quick question before we move on, because I've had a couple people ask, we're in COVID, right? So there are some people we're doing Zoom. So they're writing from other states, and maybe they incorporated in California, or they're thinking about incorporating, and they're also thinking about moving back to Chicago. Where should they incorporate, right? Like, how do you figure out where to incorporate?
Well, I think it's typically, if you know that you're on a night show, like a talk show in New York, they're going to incorporate in New York, just because that's where the production company is housed, that's where their payroll is housed. And you more than likely live in New York if you're writing, because you're in writers' rooms typically, right? Not everyone's writing in Zoom. This is not the world we intend to live in, right? But if you're if you write features, or if you are a gig writer, you may do Delaware, you may do some other state, because you're going to earn money in Atlanta, you're going to earn money in New York, you're going to earn money in LA. And so it's important for you actually have to know who you are. And where your money's coming from. And it can change, and we can adapt, and we can move, but your home state is very important, because your home state is going to, you pay taxes on all income in your home state. So that's why it's important. So you're going to pay, if I incorporate in California, and, let's say I make $250 in New York and I make $250 in California, I'm only going to pay taxes on $250 in New York, but I'm paying $500 in California, and California is not a cheap state to live in. So you have high taxes. So it's important to understand, and that's why I said don't go to LegalZoom. Actually talk to somebody who understands the industry, and actually you have to talk to us like you talk to your doctor. You have to give us all of the information, so that we can help best advise what makes sense for you. Because the girl I have
probably a couple of years, right?
We have to
give you a couple of years.
Yeah. And Sid talked about this. Like, it's a 3-year plan. Like, what's on the horizon? Obviously, you may not know if you're writing features, but you also have an idea of the trajectory you're going in. And it could change, and it may pivot in a good way, a bad way, or whatever. But we can navigate that, and we can close companies in certain states, and then add them in other states. We can be a foreign entity in another state. So there's things we can do to help you, but try to give us as much information as possible so that we can help advise and see what makes the most sense.
Right. So you have to incorporate, you have to consider all the sort of long-term issues. We have to think about taxes. So if you're in California, it's the annual $800 plus the annual $25, so about $825. And then I think somebody mentioned it, there might be an exemption from the business thing for LA for a certain amount of time for WGA, but I think you do have to pay it.
It's like 2 or 3 years for creatives, and you have to make under 300,000. I think the number is 300,000, and you get the exemption for 2 or 3 years. I don't remember the exact number. But
then it goes away.
It goes away, and the thing about LA city tax is it's based on gross revenue, not on your profit. So if you made a profit of $30,000, which that's great for income tax purposes, but for business tax purposes, you gross $250. The city of LA wants 1%, 2% of your $250.
Got it. So it can get really expensive really fast depending on sort of what your worth is. But if you're at the sort of story editor, staff writer level, you're mostly living at the 200, 250. And then when you get into sort of co-producer, producer, supervising producer level, there's different, things, but that's why it's so personalized, right? That's why you have to go to your tax preparer. And it's based on also, the income at the end of the year, not necessarily what you make. You were starting to talk about sort of deductions and what does that mean? So say I make $250, right? What do I pay when I go in and they look at my corp at the end of the year? Are there things that change that amount and what they're actually going to pay me, and like deductions and things like that?
Yeah. So one is, I'm going to put a pin on that question because I don't want you to go to a tax preparer. I want you to talk to somebody who understands entertainment. It could be a tax preparer as long as it's entertainment based. But you should talk to an accountant, a business manager, an attorney, or somebody in the entertainment industry that understands what you do. Because I have people that had great tax preparers and retail places or whatever that served them very well as W-2 employees. But as soon as they incorporate, they're like a deer in headlights. So I want you to talk to someone who understands your industry. So in terms of things you can write off, we talked about obviously payroll. When you pay yourself, you pay somebody else, payroll taxes. Sometimes when you give retirement contributions, those two are a write-off. And at the very end of the document we sent you, I have a whole list of acceptable expense categories. The two big ones that everyone wants to write off are business meals and business travel. So business meals, before the Tax Act changed in 2018, you were able to write off business meals and entertainment as long as you were conducting business. And this gives you a whole breakdown, conducting business, whatever, right? Entertainment is no longer allowed. So no longer can you write off Laker games. 3 years ago, you could, but now you can write off the food you ordered at the Lakers game, but you can't actually write off the Laker game itself. So that's a huge difference. A lot of people don't actually know that has changed. So now you have to not only track.
Is that only in town, or is that also out of town? Like if I'm in Canada,
as long as you're conducting business with a customer, a client, or a team member, then you are allowed to write it off. You cannot write off your individual meal for lunch. Does that make sense? So business travel, as long as you're conducting business, plane, train, automobile, whatever, and you can write that off.
I go to a research trip. Can I write that off?
Technically, as long as you can validate the research.
Right.
You know, it's like a whole thing. Like, I'm assuming you don't mean like a seminar. A seminar, 100%. No. You can write off the yeah. You mean like a research trip. So you,
for example, like if I was going to talk to a professor in London specifically about this project, and it's actually a thing that I could show you it's a script for, that
you are allowed,
but not if I decided to get on a cruise and just hang out and be like, I'm doing it for research.
And it gets really nuanced. Like the amount of time you spend on the trip dictates if you actually can write it off. So if you were on the trip for 5 days and 3 days were personal, then it's actually not an expense. And then sometimes they let you allocate it. So it gets a little nuanced. But I think as long as you have documentation, and this is the big piece that a lot of creatives miss, is you actually have to have documentation and receipts, and not just like receipts from the places, but you actually need to have calendar and your, mileage log and all these different things to back up what you're saying. If you were at a seminar, IRS technically says you should have the pamphlet from the seminar. Like, it's a whole thing. And unfortunately, the IRS has not gotten to a point where they understand technology yet. And so, like, some things can be digital, but some things they still want for now. Because if you register on a website, the website is now gone. How do you prove that you went to a thing? So it's important to kind of PDF stuff offline and keep track of stuff like that. Anything else, Paige?
Speaking of documentation, there are situations where if you're lacking documentation, there's a court case called the Cohen case, and it's called the Cohen rule. And essentially what had happened was the IRS went to this guy and said, oh, you don't have any documentation, you have no deductions. And so it basically almost took this guy out of business because suddenly all of his gross income became taxable. And he was one of the few cases that won, because what he said was, wait, this is not reasonable. No business can operate without expenses. And surprisingly, the judge actually agreed with him, and he was able to reconstruct his expenses by other means. And that's the reason why Belva talked about having a calendar as a form of reconstruction. He was able to show equipment that was part of his business. And in the very, like, if you just lost everything, there are methods to reconstruct expenses, but there are also what they call strict substantiation rules, where the IRS says, no, if you're going to deduct your mileage, you must have a log. And those things have kind of gone app-based. So there's things like, Mileage IQ. QuickBooks has one that tracks you. And in terms of the food, they're pretty strict. If you're over $75, you have to have a business purpose who you ate with. And that's always kind of like the tough part for people, because, for the simplest method, I always say, if you can take a folder, a big, huge manila folder, if you're just not good at, organizing, put the year, and every single time you get a receipt, put it in there, because the IRS doesn't allow bank statements to be considered a substitute for receipts. And a lot of people are surprised to know that, because they think they can rely on their year-end credit card statement summary as their form of accounting, and they basically just disregard that.
So I will add to that. So I am an Android user. Nobody, don't start a riot out there, okay? I am an Android user, and all of my photos sync to Google Photos. I love it. I'm sure there's an iCloud thing or whatever. I don't know. But I take a picture of or I have software, but I suggest people take pictures of their receipts in their Ubers, in whatever, take a picture, and then put it in folders, like literally what you go to your iCloud or your Google Photos, you can then put stuff in folders and categorize it by month, by year, whatever, because no one's keeping receipts. And the other thing is the receipt technologies on thermal printing. So if it sits in your car, the numbers fade off. If water touches it, you can't read it. So literally take a picture of it. Yes. As long as it's legible, IRS accepts that, throw the receipt away, because no one wants manila envelopes anymore. So do that.
There's also scanners.
I mean, I have a scanner, but if you're not a heavy user, you don't need a scanner. Use your phone, And then the other thing is, it's really bad. I actually take pictures of all my Goodwill donations. I know this sounds silly, but when I donate big Christmas trees and expensive purses and all this different stuff, I take pictures of it in the Goodwill bin with the Goodwill picture. And because the IRS does not always believe your handwritten receipts from the Goodwill and says that this stuff is worth $10,000. And so it's important that you really keep not just receipts, but also more documentation so that you can actually validate. And all of this has to do with the IRS's position. And so much of the IRS's position is subjective. And so one person may say this, another person may say this, And so it's important that you have the backup. That's kind of it on that.
As we talk about this, I have one more question that I think helps. There are a lot of people asking about partners. Some people are incorporating by themselves, and then other people are incorporating with, like, as a writing partner, or some people with their spouse. And how does that affect sort of what we've talked about insofar as S&C or any of the other things? Are there considerations specific to them?
So I would typically not suggest someone incorporate with a writing partner, because it's not likely that everything they write is going to be together, and therefore it may not end up being equitable, and you don't want to start changing that. So oftentimes we'll suggest that each writing partner has their own corporation, you did S Corp, and they do it that way. I do have some husband and wife teams that have one S Corp, and they're both members of it. They're both in the creative world. You want to make sure that, one spouse is not a chef, another one's a writer. We want to make sure that their business is aligned. If they align both in entertainment, then yes, 100%, then both husband and wife can be in the same S Corp or corporation. But typically you will not have two writers that are not connected intimately do corporations together. They just become independent. And then when you go sell a project, then you create an LLC for the project, and then your corporation is members of the LLC, and it gets a little bit more complicated. But you definitely want to keep it segregated, because it's not likely that you're going to do everything together.
Thank you, because you answered two questions in one about when to add an LLC. Sometimes you can do that for project to project as a way to also separate those monies from other things, which is a thing that people can do within their corps to, segregate money so that, like, if there's an issue here or there. Thank you.
And I think
I just wanted to add with the LLC, whenever we talk about a C Corp or an S Corp, an LLC can actually be taxed as either a C Corp, an S Corp, a sole proprietorship, or a partnership. So when Belva's talking about using an LLC at the top level with two S Corps underneath, what she's referring to is an LLC that's being treated as a partnership for tax purposes.
Yep, and then the partners are the S Corps that then passes through to you as individuals. And then my only suggestion is that people don't. Here's what happens, and I see this all the time. People call me, they have an S Corp, they have an LLC, they took someone's advice, and then they don't need it. And we end up having to unwind and undo everything that they've done. And so for me, if you are trying to form a partnership, you're doing a feature film, you're looking forward to sell, I just urge you not to do an LLC or incorporate too soon. Make sure you're at the right point, because if it doesn't sell, you now have this LLC that we have to file taxes on, pay taxes on, unwind it. It becomes too much work. So it costs you more money unnecessarily, and then people let it go defunct. They don't keep it up. They just have an LLC that's been sitting there for 3 years. It just becomes a nightmare. And in order to close an LLC or a corporation, taxes have to be current. So that means every tax return has to be filed. So if you started an LLC 5 years ago, never filed a tax return, in order to actually close that LLC, we have to file all 5 years of taxes. Then you have to pay the taxes plus penalties plus interest in order to actually legally close that entity. So I just encourage you not to jump ahead and not to move fast, and make sure you're getting the advice you need so that you're doing everything in the right time, because timing is very important here.
Yes. Are there other things that they need to think about as far as bookkeeping, skills they need to have, basics they need to do to maintain and keep it? We're about at 6:21, so I just want to make sure that we're also talking about whether you're thinking about a corp, you already have a corp. What are the skills that they really need to start having to stay where they need to stay to do this kind of work?
So there's a couple of things. I believe that how we treat money is a mindset. And I think that oftentimes Our mindset comes from our direct financial traumas, whether it is bad relationship, you got a car for somebody you loved, or financial or childhood trauma. So the most important part is trying to, one, make sure you understand money. And if it scares you, if it frightens you, then you have to do the things you need to do to make sure you change it. There's people who hear no evil, see no evil. I did it backwards, but you know what I mean. And they just don't want to look at it. There's people who are trying to do better. And there's people who are like, I'm on my way. I got it. No matter what, you have to be constantly trying to get better. Find financial mentors, listen to podcasts, financial books, and then you have to start tracking your money. People come to me all the time and say, well, I'm ready to incorporate. I said, how much money you make last year? I don't know. So if you don't know how much money you're making, then you're not ready for a corporation. So it's important to start tracking. There are some tools that I love. And there are links in my IG at Belva Anakwenze. And one is an app called Tiller. If you are a Google Excel type person, you'll love Tiller. Tiller goes into all your bank accounts. It tills the data out, and then it helps you put it all into a Google sheet, and then you can categorize it. It's like $40 a year, $60 a year, super inexpensive, super easy, and it works. But you have to understand Excel. If you don't do it. There's QuickBooks. There's the various versions of QuickBooks. $20 a month. You use it, and I tell somebody this the other day is that if you're trying to dig a hole and you're using a hammer, you're not going to be very successful. And a hammer is a great tool, but it's meant for driving nails. It's not meant for digging holes. And so I can give you all these tools, but if you're not using them and using them the right way, it's not going to help. So there's QuickBooks, there's Self-Employed, there's Mint, there's all these different apps, but you actually have to go in and use the information, categorize things, make sure things are going in the right flow. I gave you a list of categories that you can use. Do that. If all else fails, create a Google Sheet. The date of the transaction, the vendor, the dollar amount, and then categorize it, whether it was meals, travel, headshots, or whatever. Categorize that stuff so you guys know where your money is going. Once you do that, then we can talk about how you're spending your money behavior. I bet you some of you don't know how much you spent on Uber Eats last week or last month because it goes so fast. Now, if you have a business manager, they're probably calling you and texting you saying, hey, Uber Eats is out of control. You should go to the store. I know I do, right? But if you don't have that, you have to be accountable, and you have to go to, I look at my bank accounts every day. Every day. I know it sounds crazy, but I look at them every day. I look at my credit cards every day because I want to know what's happening. I want to see, is there fraud on my account? I mean, I don't go a week. I might go a couple days, but I will not go a week without looking at my account. And it's part of it is just, I'm not even going in to categorize things. I'm just going in to make sure everything is copacetic and everything is fine. And then monthly, I go in and categorize my business expenses, all my business stuff. I go in and categorize my personal stuff, and I keep it, and I know where my money's going. Then I can look at a month, a week, or a quarter and say, wow, I say that I value saving and putting money in my retirement, but I spent X amount of dollars on Postmates. That's a problem. So that's important. I think so people call and say they're ready, but then they're not ready because they're not doing some of the easy work. Google Sheets is the easiest, and it's free. So we can do that.
So another question, what we talked a little bit about professionals like you, like Paige. Are you paid hourly? Are you paid percentage wise? Like a lot of people don't know, right? Like if you don't have an accountant, if you don't have a business manager, you've never had this before. What are the typical ways in which people are paid? Can it vary? Can people decide? Is it flexible? What happens?
So one is, I think you should always trust your gut. So if it doesn't feel right, don't do it. I think Sid talked about this, like he went in and they were very patient with him and they made him feel comfortable. And that may be a good fit, right? You don't want to go somewhere where they're over talking you. You don't feel like you're being heard. You feel like a small fish in their, in their very big pond. So that's the first piece. Second piece is it depends on what you're looking for, right? There's business management, which is not just bookkeeping and tax. It's also like financial oversight, and I'm your sounding board, and I'm helping you buy real estate, and I'm helping you navigate retirement, and I'm helping you do all these different things, which is more than bookkeeping and tax planning. And you have a tax accountant who are only focused on year-end tax planning, taxes, and that's it. So it's no right or wrong answer. I think the biggest piece is sometimes you do what you pay for, and the second piece is feeling comfortable. So business management is usually 5%, depending on who you are, how much work you're doing. Somebody might go down to 3%. It depends. I have clients that have been with me for a long time, blah, 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 right? And then you have accountants who might charge by form. So it depends on how complicated your tax return is. If you have 5 different states, I started off in the NBA, and NBA players play in 30 different states. So they came in with 30 W-2s from all the different states. And so you may charge by form. Other accountants might charge taxes per hour. So it might be like, okay, we spend 3 hours doing year-end tax planning, took another 3 hours to prepare the return, and they might charge $325 an hour. It might be $125 an hour. It varies. I think you have to go, and then you might just hire a bookkeeper. And the bookkeeper can be $60 an hour, $40 an hour, $25 an hour. It just depends on what you're looking for. Again, I just want you to find somebody who understands entertainment. Like, I cannot express that enough. Find someone who understands entertainment, and find somebody that you feel comfortable with and that you can actually have real, honest conversations. I got to help my mom because blah, blah, blah. I got to do this for my family. And I'm not, there's survivor's remorse that happens because you're making money. No one else is making money. It's about, I'll call mom for you, but she can't keep doing this. Like, I'll call her, but she can't keep taking all your money because you don't have any money to give her. And just because you have X amount of dollars in the bank account, we haven't talked about tax. We haven't planned for your retirement. We haven't thought about the fact that you may not have a job next year. I mean, so you need somebody for 2 months, 6 months, next year, or whatever it is. So, you just have to find somebody who's open, honest, you feel comfortable with. And it might be a woman, it might be a man. Know who you are, know what you need, and then make sure you have the right person.
So in both cases, it feels like there's going to be some work that people are going to have to do some basic bookkeeping. They're going to have to be comfortable.
They're going to have to. And again, if
but they're all, meaning
right.
Your bookkeeper can't keep the receipts for you, right? Your bookkeeper.
Well, there's so many softwares. Like, literally, it is so easy. Again, Google Photos, it's free. Take a picture, throw it in a folder. In the normal world, you're in an Uber every other day. I say people go in your purse, start pulling everything out while you're in the Uber doing nothing, take pictures, and then start organizing it. That's, So for me, the cheapest, easiest way is Google Sheets and Google Photos. If that's not your gift, someone was laughing that I said that, then you need to hire somebody. If it's not your gift, then you have to hire somebody, and know that's part of the cost of if you're going to have a corporation. If you're not going to have a corporation,
you have to do it anyway. As a writer, we have to do it anyway.
I think as a human being who has to be fiscally responsible, you have to do it anyway, right? There's plenty of W-2 employees who track their spending. It's called a budget. People have budgets, right? And you have to actually compare what you spent to your budget and see how you're doing. So I think everyone should do it in some form or fashion. But, if you have to do it if you have a corporation.
Right. So as we talk about the different corps a little bit more, having a C, having an S, I think we sort of started talking about it, and you have a list of things, I think, later in the sheet that says what some of the standard deductions are, meaning, I have a C Corp, I have a cell phone, I'm 90% of the time not on my phone unless it's work related, or internet, or those things. Some of those are on your list. How do people have to deduct them? Would I have to deduct them as a business expense for a percentage or whole or that kind of thing? And then when you're incorporated as the B part of that, how does that function, meaning if you're an individual and it's one thing if you're a corp. And I think people are kind of confused about, well, you say deductions. I can get deductions as a person now. What's the difference when you're incorporated?
So I think the Page help me on the exact term. It has to be a necessary and ordinary. It has to be ordinary and necessary, right?
Ordinary and necessary, section 162.
Yes. So it has to be necessary and ordinary. I still don't know form numbers or section numbers, but I can do it. I can't. It's too much. So you have to be necessary and ordinary for your business. That's the first piece, right? And then anything that is for benefit of personal technically is not a business write-off. So people want to write off an outfit they bought for an audition. I have clients that are writers and actors, right? So you want to write off an outfit you bought for an audition. No, sir. You could wear that walking down the street. It is not a write-off, right? Unless it is actually a costume or a uniform with a logo on it, it is not a write-off, right? Things like your home internet. You would have home internet whether you had a business or not a write-off. You would pay rent in your apartment whether you had a business or not a write-off. Now, there are some rules if you're, and percentages we can start talking about. If you have a separate room in your house or a separate room in your apartment that's exclusively used for the purposes of writing, yes. But if you just write on your coffee dining room table, the answer is no. For me, and I think this all goes to judgment as well, right? Because I have people come to me and say, my last accountant said blah, blah, blah. And I'd say, well, your last accountant, I don't agree. Maybe you should go back. And so when Paige and I were planning for this, so Paige was like, so what is your position on this? And how do you view this, right? So I think it goes back to what I was saying, even when you call the IRS, it depends on who you're talking to. And some things are a non-starter for me. I'm not writing off your clothes. Now, another accountant who may be a CPA, enrolled agent, or whatever might think, oh, we'll write off 25% of it. No, I'm not doing it. So it depends on everyone's judgment. But anything that is necessary and ordinary for your business and exclusively for your business that has no personal benefit, 100% is a write-off. So again, if I bought a new suit for an interview, I can't write that off because I can wear that suit down the street. Anything else you want to add to that, Paige?
But now that we're in COVID, for example, with internet where everybody's on Zoom, where you're at home, you're working from home, no?
I mean, well, Zoom, if you have a corporation, Zoom is a business expense, right? That's different. But, so yeah, right. I mean, absolutely. That's an actual dues and subscriptions business expense. 100%, that's a write-off. But your internet may not be.
Right. Yeah, so and it will depend on the person who's your.
Yeah, a lot of it is driven by worldview, and that's the reason why there's so many different opinions in tax. Like one opinion where going back to the Writers Guild, for instance, in the temporary regulations, you had the IRS and the Treasury Department essentially fighting with each other in different definitions, and then they totally switched their position in the final regulation. So I'll give you just like stories, because the funny thing about taxes is the stories, because the way our system is designed, it's designed for fighting. It sounds weird, but the way we set precedents in tax is we challenge the IRS and we either administratively settle it or we take it to court. And so part of our updates are always like these court cases. Going back to the uniforms and why Belva takes the position she does, is there was a case where there was a nurse and she had scrubs on, and she was deducting the scrubs because she said these are used for work. Well, the IRS agent in the audit interview says to her, let me ask you something. You said you go straight home and you go straight to work. You ever stop by the grocery store? Are you wearing your outfit at that time? The IRS agent, because she went to the grocery store with her scrubs on, disallowed the expense. Another one had to do with the exclusively used as a business, like part of your home. If you're going to use part of your office, the IRS takes the position that if you use any part that you're deducting for business or personal, it's not deductible. One taxpayer had deducted the whole bottom part of their house and said that was exclusively used for business. And during the interview, the agent said, well, let me ask you something. How do you get upstairs? And he says, oh, I just walk through the stairs. And he said, well, you walk through personal use going upstairs. Therefore, the whole bottom section is not deductible. And those are kind of some, fun stories about, different things on where the IRS does that little getches, Now,
Yeah.
going back to ordinary necessary, you might have somebody where, let's just say a dishwasher. I might ask, say like you're a writer, and then you say, was my dishwasher deductible? Well, if you bought a dishwasher, it's probably not deductible, but if you bought the dishwasher for your rental property, then it could be a rental deduction. So it's also the facts and circumstance surrounding the deduction as well.
Oh, tax law, so complicated. There's so many things. I mean, I think there are questions coming up, and then something I will talk a little bit with Sid about too is about like there are some things, and I would love your opinions on this, that are very specific to writer, for example, that are jobs, right? Like going in for an interview for a show, I need to have watched that whole show. So I have to, 9 times, like half the time, I don't have time to watch TV. I keep Netflix for if I am in between jobs and I get a job interview tomorrow and I have to watch 18 episodes of blah, 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 right? Like I can go online, I can go and watch it, and I can watch all those episodes. So for some people, for some people's accountants, that is considered specific to our business because we are doing entertainment. Other people would say no. So are there some that are specific to writers, like DVDs or books, or like oftentimes we have to read things, we're looking for IP, like, is there something that people should consider in general? Again, this is keeping at the 20,000 feet of write-offs that are specific to writers or directors or actor writers hyphenates in entertainment.
I typically allow dues and subscriptions for Amazon Prime, Netflix, Hulu, Disney Plus. I typically let that go. I typically let books go if there's backup and you kept your receipt like you were supposed to, and you weren't buying chocolate bars at the checkout register. So I typically let that go. And then sometimes there's research trips. Like I had a client call me and was like, hey, I'm writing a story about X, Y, and Z. I need to start hiring this person, but it has personal benefit. And I was like, well, let's talk about it. What does this look like? Can we 1099 the person you're hiring? I thought it's really hard because it's not so cut and dry. The cut and dry stuff really is bank service fees, bank charges, postage. You bought some headshots. All that stuff is really cut and dry. Some of the other stuff is just more nuanced. But in my head, track it all, and then see where your accountant lands on it.
I would agree with that.
Great. So to that, we're going to quickly talk about a little bit of tricks and tips, Sid, of like, as a writer, just stuff. Like we talked, Belva said she loves Tiller and she loves QuickBooks. Like for me, I know some of the apps I use. I have Stride to take my mileage, right? Every time I get in the car, I turn it on. If I'm going for a business thing, if I know I'm going to a meeting, I'm going to work, whatever. That's what tracks my mileage. I have Mint to aggregate all of my expenses. It goes through my credit cards, it goes through my bank statement, say if it's a business expense or a personal expense, and deductible, blah, 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 blah. So there's stuff like that we all, can sort of do, and some of them are in the slides. But as a person who's done, are there other things that people need to consider? Like, I know that you can reserve your name for your corp now. Even if you're not ready to incorporate, you can go on the California website, search to see if your name is there. If it ain't there, you could pay a certain amount of money to reserve it until you're ready. But what other kinds of things are tricks and tips and things that you think people should think about, as they're on the long process of incorporating, if they're not doing it right now?
I think everything that Belva said is really important. Taking the pictures of your receipts. I think the biggest thing for me was tracking just how much I spend. So now that I have a corporation and I also have my own personal account, when I started laughing when Belva said that I check my bank account every day. both my personal and my business account, because I want to know what's going on. I want to know what's being deducted, what my business managers are taking out. One time I saw it 200. I said, "What is this?" Oh, the franchise. Okay, fine. But you have to be on track of that, because sometimes you'll go 3-4 months without it, and you're like, "What are all these things?" And so, to me, one of the biggest things is, if it's not daily, every week, look at your bank account, look at your business account, and figure out what you're spending and why you're spending it, because it's very important in terms of creating a budget. I try to create a budget for myself, business-wise and personally. Now that I have a corporation, I need to know, okay, in a given month, what am I spending on paper? What am I spending on printing? What am I spending on whatever? And then if I find ways, once I get it at the end of the month, I'm like, way too much, shrink it, and then something like, we talk about Netflix and cable and Amazon, all those things, just tracking how many of those things you have and figuring out how much you can cut out of that as well. Really, really important. And then having a budget. Hugely important, because I think once you start making a lot of money and Belva's threshold 250, all of a sudden, especially if you're working in TV, the checks are coming weekly. And what happens is that you start getting this false sense of, well, I can spend 10 grand this week because I'm getting whatever that is every week. And what happens is that after about 3 months, you'll see you're way past your budget, because you get into this false sense of security that checks in every week. And what that's doing is that it's allowing you to think you can spend more. So you have to stick to a budget, because you'll fly and burn through that money really, really quickly. Trust me, even the money you're seeing in TV every week, you will burn through that. And I think those are the biggest things, is you just make sure you know what you're spending, why you're spending it, and make sure it's all necessary for what you're doing, because you can quickly start to get way out of hand with stuff. And the only way you can perceive of that is by making sure every month you are tracking what you're spending. Hugely important for me. And I didn't do that for a long time.
I piggyback on that, Sid. I love what you said, because the other thing that people don't do, they don't actually look at their check stubs they're getting from their agents and their managers and whatever. And Bianca's clapping. So I have seen so many times where there has been a check that one check says X amount year to date, the next check says X amount year to date, but they don't line up. I've seen where your agent or manager is either accidentally or not taking too much in commissions. So it's very important that you're looking at your year-to-date numbers and also verifying that the accounting that your agents and managers are doing is actually accurate. I've seen it so many times where people come to me and I'm adding up their numbers for tax purposes, and I'm like, whoa, this doesn't line with what you're telling me, so let's figure this out. And I've had clients leave managers because of it. So it's important. And sometimes it's malicious and sometimes it's not. Sometimes it's just an oversight, or sometimes a check gets lost in the mail or whatever it is. So please look at your check stubs. Please, please, please. The ones that come from payroll and the ones that come from your team.
I will piggyback on your piggyback, because what I do personally, and it was the thing that I learned on my very first job that somebody was saying, whenever they get that pay stub in, they just do an Excel spreadsheet. So week to week, they're putting, what they made, what the week ending is for, the amount, the full amount, then what was paid in taxes, what was paid to your agent, what was paid to your manager. And it's also easy to know if you're missing a check. So you could quickly spot, okay, I got paid this week, but I did not get paid for 2 weeks. I'm missing checks, and you know exactly what checks you're missing. One, you should do that whether you have a corp or not have a corp. You should be able to check that. And at the end of the year, it definitely makes your life a lot easier to tally stuff up. But that was the thing I learned the very, very first year I got here. And restriction tip, I always tell people, you got Excel, you got a computer, it comes on there. Any kind of pages, numbers, whatever it is, keep those basic things, because it does help keep you honest, and it helps keep your agents and managers honest. And if your W-2 is wrong, if you're not in a corp, right? And that okay, I'm missing something about this is incorrect. But you also, as a corp, I think it's a very simple way, even if you have an accountant or a business manager, to kind of keep them honest, to be like, wait a minute, I made this amount, this is what I paid, this is what the statements say, and you have them and can track them. So that to me is the trick and tip that I always say, no matter what else you do, if you just do that, it's much better than nothing.
Even with technology, your agent's using technology, your entertainment partners is using technology, everyone's using technology, but there's still a person pushing buttons, right? And there's clerical errors all the time. And so it's not always malicious, but I'm willing to bet you that everyone here has had a check missing or something miscalculated and don't even know it. It happens so frequently because it's humans just pushing buttons.
Exactly. For me, another trick and tip I tell people, particularly if you were thinking of incorporating, there's two. One is you can expedite your application, and you do not have to expedite it to Sacramento. LA has its own, so you can expedite to LA. So if you are in a situation where, oh my God, I just got a job and I'm starting on XYZ show next week, but I really want to incorporate, there is a way to do it, but you, again, need to have already worked out stuff, but you also cannot take any checks. You cannot collect any money and put any money in until that thing is cleared. So I wouldn't actually, I've seen people do it, but they have to be all of that stuff. So the state has to clear and the federal has to clear before that happens. And if you can expedite, but you still have to be very clear about that. I tell people not to do it. It's not my thing, but I'm not an accountant, but I do know that you can expedite it. And I have had friends who expedited it in 2 weeks before they started a job, had their corp already done, was able to sign that contract, and then just made sure that, they didn't collect any checks from their job until all the T's, the I's are dotted, the T's are dotted. And then the second thing is, do not, and your accountant, your lawyer, whoever is filling out your form should tell you this already, but do not put your personal phone, email, address on your application for incorporation because it is a public document, aka it's on the internet, which means, and a lot of people do not know that. They get to the end and they're like, how does everybody have my phone number, my email, and my home address? Because you put it on your application. Do not find a P.O. box, or your lawyer can do it, or your account, like whoever will do it. You can change it later, but do not put your personal information on that thing because it becomes public information. And I know a lot of people who have had very big problems by doing that. So that is a trick and tip for me.
Yeah, let me add to that. Your corporation has to be in good standing. So if your corporation is not in good standing, i.e. you haven't filed taxes, you haven't paid your state taxes, you haven't done your statement of information, and the list goes on and on. If your corporation is not in good standing, that means any contract that you enter is null and void because technically you don't have the right to be doing business. So it's important as you're going into contracts, whether you are being hired or you're hiring somebody else, just know that if you're not in good standing, your contract doesn't mean anything because you're not allowed to do business. So that's important too. And I've had it happen for a lot of clients where people have come back and disputed the contracts because they didn't have their ducks in a row.
When talking about filing your corporation, Lord, can you hear me now?
Yes.
Yes. When you are incorporating, you can also look at websites. So for the California State website, it will tell you which application it is filing that day, meaning if an application was sent in on March 22nd and they're currently working on March 20th, they have not gotten to yours yet. If you're expedited, that is separate, but if it is regular, they are working on specific ones. So depending on your state, California, I feel like was very easy for me when I created my corp. I could watch it all the way through. I got a little notice saying when it was received. I could go and check into the website and see, okay, they are currently working on March 19th. Mine got turned in on the 20th. So I know that tomorrow they're going to be processing applications, which means I should know if mine has gone through or not gone through fairly quickly. So there's that. Another trick and tip for me that I tell people, again, I said it earlier, I took 3 years before I incorporated for me. I was getting information, I was finding out things for people, but I knew I needed a corp name. I have met so many people who have random crazy corporation names that they thought were real cute at 21, and then they've been incorporated for 20 years, and you have to realize that goes on credit cards, that goes on letterhead, that goes on your bank things. Like, pick your name, A, wisely, and B, you can reserve your name early. If I'm not ready to incorporate today, but I know I want to be called Gumbo Soup, corporation. I can check on the California website to see if anybody already has it. If they don't, I can register it and keep it. So there are things that you can start doing even before you're ready to incorporate to prepare for it. And another thing somebody told me when I was preparing is to save my money. I had money saved. I knew about how much it was going to cost me or estimate it. And so I had put that money in a bank. I already knew it was there for when I needed to incorporate. I'd have to think about it even before I was ready. So you can take 2 to 3 years to prep financially for that cost when it's coming. You don't have to wait and pull the trigger. Any other tricks and tips?
Well, yeah, you mentioned if you don't like your name, you can change your name with the state, whatever state you're incorporated in. You usually can change your name. Takes a couple weeks, not a big deal. So that's an easy fix. If you say, Belva Anakwenze Inc., and you're like, that's not creative, that's silly, you can go in and change it. So that's fairly easy. Somebody asked a question, I just lost it. Never mind, go for it. Oh, someone asked if you have an LLC, can you convert? Yes. So if you have an LLC existing, one is you can dissolve that LLC and just get rid of it and start a whole new entity. Or you can convert your LLC to a corporation, and then if you want the S corp election, then after after it's converted, then you can do an S corp election. And then
is that cheaper? Like if they,
it is
meaning
cheaper.
if I've already created and I've had it for 5 years already, instead of having to create a new one, if I already have it to transition, is that just an easier way for people who've already had one?
So the answer is yes in a couple of ways. Yes, it's cheaper because you file a form, maybe $200 to convert, at least in California it is. You also get to keep your tax ID. So if you don't have to go back to any of your payroll companies and do all that stuff, and the name is fairly similar, but instead of ending in LLC, it ends in Inc., right? So yes, so it's easy, it's less expensive, only to the fact that that your LLC is in good standing, taxes have been filed and paid, etc. Obviously, if not, then that's a whole other conversation.
Then there's a lot more work.
Mm-hmm.
Paige, Sid, are there more things that you think are like easy tips and tricks that people should think about insofar as and have one, or even things that people can be doing before they incorporate to get ready for incorporation when they are ready?
Okay, I'm going to give a tip for somebody who's totally unprepared. You didn't plan for anything. You were getting about $150,000 in 1099s, and you're kind of like just going to panic at tax time. What I would generally say is for all the money that you get in, set aside about 30 to 35% into a separate account. So if you got $1,000, put $300 separately, and then that could be your tax reserve account. And that would be a trick. What comes up a lot is bookkeeping and QuickBooks. And it's mentioned so often, a lot of times people get caught up in the software, and there's a thought that QuickBooks does the accounting for you. But just like Belva was saying, that it's just a software, you actually have to code it. And she had mentioned using Google Sheets. So what you can do to avoid having to have QuickBooks is if you're making below $200,000 a year, you can download all of your credit cards and bank statements in Excel or upload those to Google Sheets, and you can manually code those and save those for your records without having to need QuickBooks. Because sometimes the software interface could prevent you from doing what you needed to do. Another tip or trick would be, I've noticed that many clients don't actually look at their tax return, so they don't know what it says. I would recommend that you get with your tax professional or whoever that is and schedule a meeting and ask them to walk you through it. And before they walk you through it, take a look at it yourself. And then I think when it's kind of like the squeaky wheel gets the oil. The more that you're kind of like poking at your advisor, the attention you're going to get, because we get busy at certain times during the year, and there are things that you could have done, but it's kind of too late because we've passed that cutoff point. So right now through December 31st is the most important time to be meeting with your advisor. So generally, when you do your tax planning, and I'm talking to people that have corporations and that have payroll, these are the things that we plan for. We plan for the optimal amount of payroll that you should have, because your payroll will dictate how much you could contribute to your retirement plans. It also will add to your Social Security credits. We also plan for what are the benchmarks for us to qualify for that Section 199 deduction that's new under the tax code. And at the same time, we plan for what's the optimal withholding that you should pay in to cover your taxes for the year. So when March and April come by, it's just filing forms and your taxes have already been paid. If you cross into January, it's kind of like done, it's over. And I would say right now is a very important time to make sure that you are connecting with your tax advisor and making your plans. So.
That is great, especially if you're an S Corp. If you have a C Corp, that can vary depending on, again, what your fiscal year end is. But even now, I'm talking to my accountant, and my fiscal year isn't until the end of January. But also because you're paying quarterly taxes, which I don't think we fully talked that, like, 4 times a year, which was a surprise to me.
Well, if you're on payroll, it depends on how you're set up, right? But if you're on payroll, you may not have to do estimate taxes. You may have to do both depending on your situation and what your life looks like. But the idea to what Paige is saying is the optimal amount of payroll and withholding. We try to get in front of that so that we're not hit with a $50,000 tax estimated payment in January.
Copy that. Sid, are there more things that you would say from the writer standpoint that, like, you had to kind of wrap your brain around that you just didn't have to do when you were a W-2 person that people should take into consideration?
Yeah, I think Paige mentioned it earlier and I think it's important. He just mentioned it again, is you have to be planning. I'm an S Corp, and as we get closer to the end of the year, as Paige was saying, just be aware of how much you've taken out in payroll, what you've paid yourself as an employee, because if you have a lot of money left over in your account, you're going to start paying a lot of taxes on that, and so you need to be aware throughout the year. Everybody's different, but my business manager says generally try to pay yourself as an employee every month or every 3 months, so that you feel like as you're going throughout the year, you're getting the right amount of taxes being taken out, so you don't get hit with sticker shock at the end. This is just for after you've incorporated. It's really important to understand you are an employee of your own company, and so you need to treat yourself as that employee and really have a plan for 12 months. Based on your earnings, what do you want to get paid per month? How much do you want to be taken out of your corporation? Treat yourself like an employee, like you're working for somebody else. And I think if you have that mindset, it really helps you plan throughout the year. So that's the biggest thing for me, is learning that Sid Quashie is the writer, but I'm also the employee of my own company too. And it's a mindset you have to change. As a writer, we just get the money, we spend it. When you have your own company, you have to understand there's one side of my brain is a writer, the other side of my brain is the employee of my own company. So that's my.
And I just wanted to also add that for the higher earners out there, like the producers, co-producers, for those of you that have pensions in addition, to the guild, and you have like defined benefit plans along with like 401k plans, make sure the actuaries are also coordinating with the guild pension benefits, because you could have a situation where it adversely affects your benefit with the guild and you might not even realize it. So make sure the plan advisors are doing that. For people that are, maybe they're not in the highest marginal tax rate, there's something you could look into called a solo 401k with a Roth component. Sometimes you get into an income threshold where you can't contribute to a Roth, but through your company, you could set up a solo Roth 401k plan, and it's a backdoor into it, because the Roth, you won't get a tax deduction, but it comes out tax-free later. My advice generally is that, mine's very unconventional. Most people will say maximize your tax deduction, but I always have to remind people that you're actually just deferring the tax until later. And, I personally believe taxes will probably go up later. So just make sure you're not putting all of your eggs in that basket, and you're also looking at tax-free, investments that come out later as well.
And Paige made a good point, though.
Yes,
The reality of it is that you need a team of advisors. The same way you have an agent and a manager and an attorney, you need, financial planners, accountants, business managers. So you need a team of people to help you manage your money. And it could be a bookkeeper, an accountant, and a financial planner. But as you start going up the echelon of, this industry, then you actually need a team because, Paige and the financial advisor need to be on the same page. And Paige may have one reason why he's saying no. The financial advisor is saying something different. And then there needs to be a conversation with the client in the middle saying, well, this is my vote. This is my vote. What do you want to do? And so it's important because a big piece of this is, like I've been saying, it's all about someone else's perspective. It's all about my perspective. I come into your situation with my life experiences, my upbringing, my expertise, and I'm trying to tell you what I think is best for you. And so it's important that you have a bunch of advisors to help navigate that because it's a lot. Tax is a lot by itself. Accounting and bookkeeping is a lot by itself. Understanding wealth accumulation is a whole other conversation. Real estate. Do I buy a car or lease a car? Like this money world is so vast and so many moving parts. It's important that you have a lot of people to advise you, but that comes at a price.
And to piggyback on something you just said, Belva, that's interesting is also they're there to advise you, right? Like you have to be in the driver's seat to know what you need and you want. And that is what's going to so you can't go to these people and kind of be like, you do it. I mean, you can, but that's how people get robbed. That's how people lose their money. That's how people are like, oh, I don't know why I'm missing like $1 billion. You have to be in the driver's seat. And that's why when Sid says you have to be your own business owner, you have to think about it that way. I am in the driver's seat, so I'm going to get a PR person, I'm going to get an accountant, but they work with me, for my vision. And that's even when you pick and decide which corp you're in. A couple people have asked, like, why did I pick a C corp? Because I feel like I'm the weirdo here, because most people do, pick S corps. And for me, it was several different things, but it was very personal into sort of finances. Like S corps are pass-throughs, which is great, depending on what your job and what your spouse's job is, or if you're single or you're not single. My husband has a job in which it's really complicated, so it was actually partly his situation that made it easier to decide between the two and not doing pass-through. But then there were other benefits to having a C corp for me that I thought was really helpful, like having the split year, like the annual year and the fiscal year not being the same. If I had a really, really good year one year and I needed to be able to split that between 2 years, and I knew that like I'm going to be without a job next year, but I have had the same job and this one's ending. I don't know when my next job is. I knew that I could sort of shift, and then we can sort of deal with taxes in that way, which is a thing. The way that medical bills were paid are different. I'm sure when taxes change, that might change. But, for me, medical bills, when you're in a C corp, I believe it's different. It's not seen as income in the same way. I think it's deductible in a different way than it is if you're an S corp. I think C corps are the only corps in which you can donate money to charities and have that also, to a certain extent, be deductible. I'm also a theater person, so, I tend to donate to theaters and produce theater and do things like that. So advantages to me to having a C corp that were very different than having an S corp. And so again, it's going to go down to your personal needs, wants, desires, vision for your career, vision for your life, your family structure. Like all of that is so personal, which is why we're trying to stay at sort of the 20,000 feet level of just the basics. But Sid, I mean, when you were considering having an S corp, have you thought about changing? Do you prefer to have this? I mean, like, I don't think it's necessary to switch. I just wonder, because somebody's asking me, like, how did you pick an S?
I like my fiscal year ending at the calendar year, and I felt like the S corp gave me the fact that it passed through was really important to me when it was explained to me the main difference, and I like the pass through aspect of it. So I think those were the two main considerations I had for picking the S corp. But C corp, I think it just depends on your situation, and you can always change too. So it just depends on what, like, you have a different situation with your husband and how you wanted to do your fiscal year, and that it's great for you. And you may find that, oh, you know what, I'd like to try C corp because S corp's not working quite. You talk, like Belva said, talk to your team, and you guys all decide together what's most beneficial going forward. I think she was so on point when she said that, because you are part of a team, and they're there to give you advice, and you need that. Just like you have a manager, an agent, whatever that is, they're there to kind of service you and to kind of work towards your goals. So I think you're right.
And when you say pass through, it just pass through to your personal expenses,
to
correct?
my personal.
How does that?
Yeah, exactly.
Yes.
Yeah.
For me, I'm double taxed, which is why most people don't pick C corp. I am taxed when I take money out, of my corp, for my corp to pay me as Bianca the writer, and then there is a tax on the corporation depending on what money is left in the corp at the end of the year. That would be a separate tax.
Yeah.
They still do the zeroing out, and they try, of course, to. I mean, that's what accountants do to help you pay the least amount of taxes, but you pay. And then payroll taxes and different stuff like that. So it is a different structure, and you get benefits and whatnot. We have about 4 minutes left.
I will also say that the difference between a C corp with the new tax law is the tax federally is capped at 21%, where your federal tax rate as an individual is now 37. Is that right? Yeah, 37. Yep. So if you are a C corp, you're paying 21% compared to 37% at the highest tax bracket. I mean, so it could also make sense from a tax perspective, but we're talking about once you become a high earner. But it could work for people.
And if you have a spouse who is a high earner and suddenly you're in AMT land, or if you have somebody who lives or works in another state and you're taxed in multiple states, that's where it gets to this weird personal.
Yeah.
Bleh.
I just wanted to add something real quick, going back to the whole bookkeeping thing. If you're unsure about an expense, just create an account if you're doing your own bookkeeping that says, like, ask my business manager or my tax person. And if you're unsure, don't just not book it, because you might be missing out on an expense that you could have qualified for.
Great. So we're in our last 4 minutes. We're going to go around. Everybody can get anything and everything you can sort of think of that we haven't covered that people might need to know. I will say you absolutely, positively, especially if you're incorporated, need to have separate accounts. You cannot be spending personal money out of your business account, and you should not be spending business expenses out of your personal account. Get a separate credit card, get a separate account. They should be separate. If you need to deal with it and deal with it at the end of the year of I mistakenly paid a personal thing out of the whatever, that is what you're accounting for, and they can help you with it, but separate the two things. If I say nothing else, that is going to be the last thing I say tonight.
That's a good one.
Huge.
That's a good one.
Yeah. You guys want to try to do some questions? There's a question about should you try to keep money in your corporation, and if so, how much?
Depends on depends on your business and what your overhead is, et cetera. So it's that stuff is personal. It just depends on your business inflow, outflow, and your personal life. There's no way to answer that, really.
Got it. And how much typically do people, what does a business manager cost, or what does a accountant cost in general gaps, which is a hard one?
That Page, go for it.
So what Belva talked about was there's different type of services. Some people will charge an hourly rate. Some people have base rates. Some people have relationships where they're business management relationships, where they're based on a fee, based on gross revenue, and you handle everything for the client. So it depends on what type of plan that you have with the client. For my particular practice, we have an a la carte service for people that are just kind of starting out, and then we have a business management service for people that are more established and don't even have time for their own plans, and the fees vary greatly. So if you're someone trying to do everything yourself, we have an engagement sheet that says we are responsible for this, because a lot of times you might go to a professional and you made the presumption that they were taking care of everything for you, not realizing that, nope, we only do your tax return. You were responsible for your Secretary of State. You were responsible for your city tax, your payroll, and what have you. So I think for your own relationship, it's important to understand what you're engaging your advisors for, and that's pretty important.
Awesome. Belva, what is your last thought? Or what do you want to answer?
I don't know. I think that's it. I answer all my DMs. So if you want to DM me, feel free. But I'm good.
You know, I didn't put my
No
contact.
more tricks and tips?
I mean, they're all on the sheet.
Yes, you
Separate
do need to.
accounts, but I love three different banks. I love credit unions. I love big banks, and I love online banking. Credit unions have great lending rates. Big banks are good for everyday checking, and then online bankings have the best savings rate, and then it makes the money inconvenient, so you can't spend it. It makes it harder to move the money, so it helps you save better.
Okay, if you're looking to refi the rates right now, I've had a client who got a 2.625 on a 30-year fixed. If you reflect on slide 26, there's something called an entity comparison chart, and it will basically give you the executive summary of things that we talked about tonight. So if your brain kind of exploded for the remaining people that are here, congratulations for making it this far.
Sid, what about you? Any finals?
I mean, I think everybody's covered things. I think the biggest thing I would say is don't be scared of getting into the pool of corporations. It's not, it feels like Greek when you start, but it's really not. And don't be afraid to ask questions. There's no dumb questions when it's about your money and your future. So make sure, like Belva and Page said, when you do take on, the professionals are going to help you. Find out what exactly are you doing for me so that there's no gaps. Because if you think they're doing something and they're not, you're going to be in trouble come the end of the year, especially on an S Corp. Make sure you all are on the same page. Ask every question. Don't think I'm bugging them. They work for you and with you. And that's what I would say is don't be scared. I think it's the benefits for me when you're at the level that we're talking about, they do mostly outweigh the negatives. And so I think it's something that if you're afraid to, don't be. Get into the pool, learn as much as you can, ask as many questions as you need to. That's my advice.
I love it. And it doesn't have to happen immediately. Like I said, I took 3 years of asking questions of different writers, of accountants, lawyers. I was asking all kinds of questions from people just to know what I didn't know. And I found out little bits and pieces about saving money for it, knowing that it maybe costs anywhere between $2,000 to maybe $4,000, sometimes a little bit more, depending on people and who you use, to incorporate. Right? Like I knew that I needed to save about $4,000 to $5,000. So I took that 3 years to make sure, okay, I got my money saved. And then I looked for a name and I just got the bits and pieces and I didn't feel like I needed to do it all at once. And so I would tell people my last advice is that it actually wasn't as hard as I thought it was. A lot of it was very much Greek. The first year was definitely the hardest year, meaning it was the most paperwork, it was the most thing, it was the highest learning curve. It was my accountant that I had before this is actually not a good accountant, had to change him in the middle of the year. Most crazy things about my gap in knowledge in that first year. Now I'm in year 3 and it's fairly set it and forget it, meaning I now know what I'm going to expect. I now know that quarterly for me, I pay taxes. It's kind of low. It's not bad, right? And I know at the end of the year what I'm going to have to do and when I have to call them, when I have to email them. It gets much easier over time. So don't be afraid of it. Learn what you don't know when the stakes are lower. So if you have not incorporated and you're thinking about it, thank you for coming. Hopefully we were helpful in that first step. Learn those intermediate steps and then do it. But there is Paige and there is Belva. Their information, I think, are mostly you guys added, Belva, I know you added your information. Paige, did you add your information into the?
You could just email me at my first name, last name at Gmail, and then there's a period between my first and last name. So Page, Villaluna at Gmail, and I'll be more than happy to help you out. I know there's people that have asked about cross-border transactions with Canada, and that's something that we all deal with. So that's probably more on an individual basis. But yeah, we can, but either of us can handle any of your questions.
Love it. This is all very personal. Our goal was really to give you the baseline so that you can make a choice and start finding people and knowing what you don't know. And people who are ready to do it maybe feel even more excited and they're going to do it this year. Maybe it's next year. We'll see. But we really thank you for coming and spending the evening with us. You have the PowerPoint and our slides. So hopefully that's even more information to dig into. There were a lot of links at the end that you can try and read more stuff, but at least you have the basic jargon. Sid is another writer with me, and we are currently writing an episode, so I'm gonna let him go because we have pages due soon. But I am super thankful that you agreed to do this for me. I really appreciate it. And thank you, Paige, and thank you, Belva, for giving your expertise. And thank you for everyone who has joined us. I hope this was helpful and inspirational. I am the co-chair of the CBW, and I'm also on the committee of the Writers Education Committee, and they are our co-sponsors, so I feel bad that I did not announce that earlier. And once again, the WGA does not endorse any particular form, fashion, method, all of the above, any legal things I need to say of how to deal with finances. This is all very personal, only educational. So know that now. But yeah, we thank you very much. And if you have more questions, definitely let us know, and have a lovely evening.
Good night, everyone.
Good night. Thank you.